In Chapter 13, we'll cover the accounting for current liabilities and contingencies. So before we get into some of the details behind liabilities, I just want to point out that in general, for any accounting item, we generally deal with four major issues. Right, so the first is recognition and classification. Okay, so really this just deals with when do we recognize a financial statement item, and if we're going to recognize a financial statement item, where on the financial statements are we going to put it? So this answer is when do we recognize items? And where to put it? Okay, the second issue we deal with is just initial measurement. So initial measurement kind of goes hand in hand with recognition and classification, in that if we're going to recognize an item on the financial statements, we're going to put some kind of value next to it. And so initial measurement is just the value of the item at the time of recognition. All right, so a basic example, if we buy a building for $100,000 cash, right, we know we're going to recognize this as a building. It's going to be a long-term asset, and the value, we value it at the initial purchase price of $100,000. So here we've recognized the building, we've measured it at a value of $100,000. So we've just done recognition and initial measurement. Right, however, we know after we buy the building, we've seen before in the past that we're going to depreciate the building over time. When we're doing this, we're dealing with subsequent measurement. Right, so subsequent measurement is just how does the value of the item change through time. So how do we measure the value of the item after recognition? Right, so for example, for buildings, we depreciate over time, and that reduces the book value. Right, and then the very last thing is just disclosure, which just means, we can't capture all information in terms of numbers. So for example, for depreciation or for a building, we disclose the additional information, such as what depreciation method are we using, and so on. So I'll just call this additional qualitative information, where we're just disclosing some accounting method and so on about the item. All right, so as we go through this chapter, everything we cover deals with one of these four items essentially. Right, so I'm telling you this now so you don't get too lost in the details. Right, you can take this framework and apply it to everything we learn in this class. Okay, so that being said, whenever we first start covering a topic, we're first going to cover the definition, because the definition gives you guidance as to if we're going to recognize the item and where we're going to classify it. All right, so a liability is simply put just an obligation. Essentially, someone's done something for us in the past, and we have agreed to give them something in exchange. Typically, we'll give them back cash or provide some good or service to them. Right, as I'm sure you know, liabilities can be current or long-term. In this chapter, we're focusing on current liabilities, and the next chapter will focus on long-term liabilities. Okay, so a current liability, if we recall first back to the definition of a current asset is just some resource of ours that we're going to consume within a year or within one operating cycle, whichever is longer. For this class, we'll just use the year cutoff to distinguish current from long-term assets and liabilities. Okay, so if we expect to use it within less than a year, it's current. If it'll take longer than a year for us to completely consume it, it's a long-term asset. Now you notice the definition for current liability is an obligation where we're going to use resources classified as a current asset, or we're going to satisfy the obligation through the creation of another current liability. Right? It's not just a coincidence that current assets and current liabilities are both expected to be consumed within a year or less. Right? Generally, you're going to pay off a current liability by using a current asset. And so we've created these two classifications because we can compare our current assets to our current liabilities to really determine, well, are we going to be able to pay off this current liability? Right. However, in some cases, instead of satisfying a current liability with a current asset, such as cash, we could create another current liability. So for example, if I owed one of you $1,000, I could borrow $1,000 from someone else to pay you back, and then I'd owe someone else another $1,000. So I've paid off a current liability through the creation of another current liability. So the next slide just has all the current liabilities that we're going to cover in this chapter. We'll skip some of these topics, but we will cover most of them. I'll let you know as we go through the topics which ones we're going to skip. So the first type of current liability that we'll cover is an accounts payable. You should have covered accounts payable in Principles of Accounting and Intermediate 1. Right, so we'll briefly talk about accounts payable, but since you've covered this in 2 classes already, we're really not going to do too much with accounts payables. So an accounts payable is just an open line of credit, generally that we have with our suppliers and the people we deal with on a daily basis. Right, so it's important to understand accounts payable is an oral promise. Right, it's an open account, which means there's not a formal contract. Right, so when we deal with AP and people that we owe money to, we're pretty much just operating on good faith that we're going to pay them back. Right, so of course there's terms of sales like 210, net 30, and so on. As I mentioned again though, right, you've already covered this topic before, so we won't get too much into this. Right, so I just want you to understand that accounts payable is an open account. There's no formal contract. Just as a quick example, let's just say we buy, let's say $500 of supplies on account. You've done before the journal entry for this. If we buy $500 of supplies on account, supplies have gone up by $500, so make a debit. And we pay for these supplies on account, so we credit our AP for $500. Okay. We can contrast AP, or accounts payable, with notes payable. Unlike an accounts payable or notes payable, a note just means a contract. So now we have an actual written promise. Right, so this is generally more formal than, say, an accounts payable, where it's just an oral promise. Notes payable, sometimes we'll pay for purchases with notes payables, but generally notes payables will result from financing transactions. In other words, we borrow money from a bank, we sign a note, and now we have a notes payable. Similar to any other type of current liabilities, notes payables can be short-term or long-term. Right? If we expect to pay back the loan less than a year, it's short-term. Longer than a year, it's longer than 1 year, it's a long-term. Last thing I want to point out for notes payable is that they can be interest-bearing or non-interest-bearing. Right, so non-interest-bearing, same thing as saying zero interest-bearing. Right. In both cases for these notes, we're still going to be paying interest on the note. The only difference is whether the note explicitly or outright says the amount of interest we're going to pay. So with the interest-bearing note, we might see something, for example, it's a 5% note. A 5% note means that we're paying 5% interest. With a non-interest-bearing note, the interest is built into the face value. Right, so in other words, the note won't actually state an actual interest rate. So it won't say something like 3% interest to 4% interest. Rather, what happens is, let's say the face value is 100,000. If you forget what that means, face value is just the amount of principal or the amount of the loan due back on the maturity date. Right, so if the loan's due back in a year and we owe back $100,000 in a year, face value is 100. Right, we can contrast this from the actual sale price or the issue price. So what happens with the non-interest bearing note is the issue price will always be less than the face value. So let's just say, for example, here, the issue price is $95,000. So what happens in this case is we borrow $95,000, but we have to pay back $100,000. Right? This difference here of $5,000 is really just interest. It's the amount that we have to pay in order to borrow the money. And if you think about what interest is just payment for the use of money. Right, so what I mean by non-interest bearing is even though over the life of the loan we'll pay $5,000 of interest, the note itself doesn't state exactly what percent of interest we're paying, although we could calculate it. So let's take a quick look at an example of interest-bearing note, and then we'll look at the accounting entries we make for a non-interest-bearing note. All right, again, hopefully this should be a review for you from principles or intermediate accounting. So let's see, National National Bank agrees to lend $100,000 on March 1st to Landscape Company if Landscape signs a $100,000 6% 4-month note. Landscape records the cash received on March 1st as follows. All right, so first we'll make the entry for the recognition of notes payable. All right. And we're recording it from the perspective of Landscape. So we're the one borrowing the money. If we're borrowing money by signing a note, well, we're getting cash, so we'll debit cash. Right, and we're getting lent $100,000, so we'll debit cash for $100,000. Let me just adjust this a little bit. All right, and then our credit here, if we debited cash for $100,000, our credit in this journal entry should answer how we got that $100,000. In this case, we got the $100,000 by signing a note. A note payable is a liability, so to increase that by $100,000, make a credit. All right, so that's your journal entry for the recognition. All right, so part B, we'll make an adjusting entry for interest expense and interest payable, and we'll assume financial statements are prepared semi-annually. Okay, so now we're accruing interest. All right, we took out the loan on March 1st, 2017, and we're making this adjusting entry as of June 30th. All right, so as of June 30th, we're accruing interest for March, April, May, and June, or the full 4 months. Interest is accrued for 4 months. Right, and so to calculate interest then, principal times rate times time. Our principal in this case is the $100,000. Our interest rate, we have a 6% 4-month note, so interest rate is 6%. And just like in your other classes, your interest rate is always stated in annual percentage terms. If it's stated in annual percentage terms, we want our time variable also stated in terms of a year. Since we're accruing interest for 4 months, there's 12 months in a year, so our time variable is 4 out of 12 months, or 1/3. Right, and that should get you out to $2,000 of interest expense. Right, now since it's a 4-month note, that means technically we won't actually pay the note until July 1st. So as of June 30th, we're just accruing the interest. So no cash payment. We'll debit interest expense to recognize the expense of $2,000. And since we're not actually paying the interest on June 30th, we'll credit interest payable. Right, because we'll pay it on the next day. So for part B, right, you're out to a debit to interest expense, credit to interest payable. Right, so part C, we're recording the payment of the note and accrued interest on the maturity date. Okay, so now we're actually paying off the note. We accrued interest of $2,000 on the previous day. We're now going to pay that off. If we want to remove a liability, we'll debit that amount. So we'll debit back interest payable. We're also going to pay off the note. So we'll debit note payable. Right. The face value here is $100,000. So we'll make a debit for $100,000 to pay off the note. And then since we're paying off both the note and the accrued interest, we'll make a credit to cash for the sum of 102. Let's move on to an example of a zero interest bearing note. So on March 1st, Landscape issues a $102,000 4-month zero interest bearing note to cash from National Bank. Present value of the notes, $100,000. Landscape records this transaction as follows. Okay, so in this case, the face value of the note, of the zero interest bearing notes, 102. Present value of the note is $100,000. So this is the amount that we're actually embarking. Okay, and again, face value is just the amount due on the maturity date. Okay, so when we first record this, we got $100,000 cash, so debit cash for $100,000. Right, and then your notes payable, always recorded at face value. So always at face. Right, and then the difference between the issue price or the present value of the note and the face value is our discount or premium. We know we want debits to equal credits. Right, so in this case, since debits are lower, we'll be making a debit to our discount on notes payable for $2,000. Okay. After we've recorded the discount, or as we kind of talked about earlier, the discount on the notes payable, this really just $2,000 really represents interest. Right? And in particular, we mentioned over the life of the loan, we're going to amortize this discount. Right, just to make sure we're covering all the bases, your discount on the notes payable is a contra account. What that means is it offsets the value, or it offsets the value of the note to get to your book value. So in other words, on the issue date, our face value is 102 for the note payable. From that, we'll subtract out the discount on the notes payable. That gets you to a $100,000 book value. All right, so more generally, face value, add or minus your premium or discount gets you up to the book value of the note or even a bond. All right, and again, this discount just represents interest. You can amortize the discount or the premium using straight line in this chapter. In a later chapter, we'll learn effective interest, but don't worry about that for now. Okay, so we'll take our $2,000 discount. The life of the loan, if we go back to the previous slide, is 4 months. So we'll split it over 4 months. So that gets us to $500 per month. right? And this is our straight line. Okay, so that means each month that passes, we'll recognize interest expense of $500. And since we're amortizing the discount, we're going to reduce the discount each time we recognize it as interest expense. So we'll credit discount on notes payable for $500. And this would happen assuming we're making adjusting entry at the end of each month. All right, so let's run through another example. If I were you, I would recommend just kind of pausing the video here and trying to make these journal entries yourself and then coming back after you're done. Okay, so we're given 3 transactions here. We'll prepare journal entries for each transaction. We're also going to be making adjusting entries as of December 31st, so the end of the year. Okay, so first transaction happens on September 1st. September 1st, we purchase inventory from Orion on account for $50,000. Darby records purchases gross and uses a periodic inventory system. Okay, since we're using a periodic inventory system, any purchases of inventory go right into your purchases account. If we were using a perpetual inventory system, then we would debit inventory. Right, we record purchases at cost. So cost here is $50,000. And then our credit here should answer how we paid for the purchase. Right, we purchased it on account. So we'll credit AP for $50,000. Okay. No adjusting entry is necessary for this on December 31st. So then October 1st, we issue a $50,000 12-month 8% note to Orion in payment of account. Right. So in other words, we purchased on September 1st $50,000 inventory on account. A month later, we're now just issuing a note in payment of that account. Okay, so we'll just capture the payment of the account first. So if we're paying off the accounts payable $50,000, we need to reduce it by 50. So we'll make a debit for 50. And then our credit here should answer how we paid for that account. We paid for it by signing a note. So we'll credit notes payable for $50,000. Right, since we signed a note here, if it hits the end of the year on December 31st for this transaction, we would end up have to accruing interest. Right, so for this note, interest accrues. Sorry, can't type here. So interest accrues from the issue date from October 1st out until the date we're making the adjusting entry to December 31st. If you had me for 301A, or even if you didn't, hopefully your professor told you to always count on your fingers when you're accruing interest, because it'll keep you from making silly mistakes and missing a question on an exam or on your CPA exam just because you miscounted by 1 month. All right, so in this case, you're going from October, November, December, or 3 months total. Okay, so 3 months. So for our interest, we'll take our principal, the $50,000, multiply by the interest rate of 8%, and then we'll multiply by 3 over 12 months. All right, so this gets us to 4,000 times 1 over 4, or $1,000 of interest expense. All right, so we'll debit interest expense for $1,000. In this problem, we're not told when the interest payments are made, so we'll just assume that they're not paid quarterly, so we'll just credit interest payable in this case. Right. In other words, we can't credit cash because we're not actually told that we're paying cash on this date. All right, so that's our adjusting entry for the second transaction. Let's now move to the final transaction, October 1st. So here we borrowed $75,000 from the Shore Bank by signing a 12-month, zero interest bearing $81,000 note. Okay, so if we think about what's happening here, understand the transaction first, and then it's easier to journalize it. All right, we borrowed $75,000 cash, and we signed an $81,000 note. All right, so we know we got $75,000 in cash, so that means debit cash for 75 grand. We got that cash by signing a note at $81,000. So we'll credit notes payable for $81,000. Right, another way to think about this, always record your note at face value. Face value here is $81,000. Finish this journal transaction. Remember, debits must equal credits. Right, the difference between the issue price of $75,000 and the face value of $81,000 is your discount or premium. In this case, since the issue price is less than the face value, we have a discount. Right, so we'll debit discount on notes payable for the difference of $6,000. Right, same thing as before, hits the end of the period, we need to make our adjusting entries on December 31st. This has the same issue date as the previous note, so we're accruing interests or amortizing for 3 months. Okay, in this case, our discount is $6,000. The life of the note is it's a 12-month note. So if we're doing straight line amortization, right, we'll take the discount, $6,000. We'll divide that by the life of the note of 12 months. Right, and that means that each month that passes, we'll amortize $500 of the discount each month. Oops, sorry. Okay, since we're amortizing for 3 months, we have $500 discount per month times 3 months, which gets us to $1,500 of amortization. So we mentioned earlier, discount just represents interest expense. So we'll debit interest expense for $1,500, and if we've amortized away $1,500 of discount, we can reduce our discount on the notes payable by $1,500. And that's your journal entries for this slide.